Welcome to a discussion on ratio spreads and beyond. This discussion was held on our open discussion Friday session on January 25th, 2019. Now, on our Friday open forums, every Friday at 4:30 p.m. Eastern Time, we host an open discussion for options investors. And you're welcome. All questions that are brought in are handled. Last Friday was no exception, but a glitch occurred in the first 20 minutes. This portion of the presentation was not recorded and the live screen did not change. We still want to address the topic that was discussed. So the following discussion is on ratio spreads, back spreads, management of ratio spreads, comparisons to butterflies, broken wing butterflies, and other ideas is essentially what we covered in the first 25 minutes of Friday's session. We'll also post the remaining topics that were covered after that first half hour. The initial question came in from Jerry prior to the webinar via email. Jerry said that some long calls seem to be capable of being used in a ratio call spread technique similar to income method number 5. This is in reference to the radioactive trading techniques where we use a ratio spread in the married put structure of owning the stock and owning the put for benefits and to avoid risk. But like buying 2 long calls followed by selling to open 2 times higher strike calls, is this a valid technique and what is it called? Now also, if the stock goes down, my 2 times short calls can be bought back at pennies, but when the stock goes up considerably, the short call is now in the money and must be bought back at a higher cost. How do you adjust in that case or roll? Okay, let's go back to step 1 and break down just the simple structure of a ratio call spread. Is this a valid technique and what is it called? Well, it's called a ratio call spread. When I buy calls and sell twice as many at a higher strike, it's a simple ratio call spread. If we had a stock trading at 67, I might buy a 66 strike call and then sell 2 68 strike calls, hopefully for a credit. That gives me that flat line profit to the left of the profit and loss chart. I get an extra bump if the stock's trading right at $68 for the value of the long call. But it does take on an infinite risk to the upside in the straight structure because half of the calls you sold are naked. Is it a viable strategy? Well, look at the profit and loss chart. Doesn't matter what prices you use or what stocks you use. Does this match your trading goals? And would you consistently pick stocks that stay within a trading range near a particular strike price to get close to or around that maximum profit at the peak? Might be something to use in a bearish strategy or in a bearish market. But again, there are better strategies to use if you feel you are in a bearish market. Ratios can also be done with puts, of course. I might buy a put and sell 2 lower strike puts to reverse the profit and loss chart we just saw. Or I can reverse the entry of the calls to create a ratio back spread. If I sell the lower strike and buy 2 higher strike calls, I might still get a credit, but I remove the infinite risk to the upside. You can do ratios with different expirations to create a calendar or diagonal ratio, and they can be done in very different ratios: 3:2, 5:3, 7:4, 7:5, and more. So there's a lot of variations that can be used. Here's a quick comparison of the ratio spread types. In the upper left corner, that's our standard 2-to-1 that Jerry was asking about. Buy 1, sell 2 higher strike calls, look for a credit. Ends up with an infinite risk to the upside. If I flip that over to the right, if I sold that 66 call and bought 2 68s, I still get a credit to have profit if the stock falls. Rather than an infinite risk to the upside, I have an infinite potential profit to the upside because I have twice as many long calls as the short. But if the stock does end right at the strike prices of my bought options, I take the maximum risk. In the lower left-hand corner here, we see a calendar ratio at 2 to 1. It's probably going to be done at a debit. I'd want to buy the further out option, I'd want to buy the option further out in time, one contract, and then sell twice as many shorter term. In this case, it might just be best to keep a straight 1-to-1 diagonal, unless you can get a really good credit in this case. And then in the bottom right-hand corner, we see a call ratio spread with that 7 to 9 combination. It's uncommon, but you see how the risk-reward graph is kind of skewed as you start to change the ratios. Let's get back to the question at hand. If the stock goes down, the short calls can be bought back at pennies. That's true. Bought a 66, sold two 68s, the stock falls to 65. I can close out of those short calls cheaply. However, the goal of the strategy is to hope that the stock is trading right at or near the shorts, or at least between the strikes. But the main question is, when the stock goes up considerably, the short call is now in the money and must be bought back at a considerable cost. How do you adjust in that case or roll? This is the reason one might not consider this strategy viable. And it's something I would never do around earnings by itself. I don't like to see positions that have an infinite risk in one direction, or a considerable risk in one direction, for the hope that the stock's trading right at a particular strike price or very close to it to look for a leveraged return. Let's take a real-world example similar to what we saw and similar to the trade showed on Friday. With Starbucks trading around 67.05, 67.04, I typically find the best opportunities for a standard ratio call spread using strikes just under and just above the stock price. In this case, I might have looked out to February 15th, about 14 days out in time, and bought a 66.50 strike for $1.25. At the same time, I'm going to sell to open two February 67.5 calls just out of the money for 75 cents. So I get $1.50 and my total net credit is 25 cents. So now if the stock falls below 66.50, what happens? Well, all calls expire worthless at expiration. We keep the 25 cents. The max profit we see here is $1.25, or $125 for a standard 2-to-1 contract size. Well, if the stock's trading right at 67.50, those two shorts expire, and my 66.50 has a value of $1. I sell to close the 66.50, I keep the 25 cent net credit, I have $1.25 max profit at the peak of our profit and loss chart. Now, why is this only a 1.9% return? Well, the reason why is because one of these two calls is naked, and you're going to have to put up some margin with your broker in order to cover the obligation of a naked call. Essentially, what we're looking at is a bull call debit spread. One contract bought at 66.50, one sold at 67.5, with an extra call sold to cover the cost. It does mean that extra sold call is naked, and that gives us the infinite risk to the upside. This might not be a very good use of leverage or margin, depending on what your broker requires to have a naked call sold in this case. But let's break down those numbers further. We take in 25 cents. So if there's a catastrophic drop, a bear market, an unexpected event, we at least keep 25 cents of net credit. The max, again, is $1.25 at the peak, because we can close out essentially that bull call debit spread or that extra long call for a max profit of $1 if the stock's right at 67.50. That return is only 1.9%, and that depends on the margin requirement your broker has for a naked call, because you do have one or two, depending on the ratio you use, naked calls open. And the infinite risk to the upside, well, that's the risk of the naked call. If the stock suddenly gaps up, good news comes out, positive pre-earnings announcement, you're behind the eight ball very quickly with this strategy. And that's one of the reasons why it's maybe not as commonly used as other leverage spread positions, your standard credit spreads, debit spreads, maybe even iron condors. Again, what are the potential outcomes? Well, the stock falls below both strikes, all expire, we keep the credit. This is typically why you want to enter a ratio call spread at a credit rather than a debit. If the stock's between the buy and the sell, that's still good. Your short options that you sold expire worthless, and you can sell to close the long. Let's say Starbucks stays right at 67 for the next 15 days with some ups and downs in between. My 67.5 calls expire on February 15th, and I can sell to close that 66.50 call for 50 cents. So I make 75 cents profit, not the full 125, but better than the 25. If the stock is right at the sold strike prices, well, that's the best outcome. That's the win. If you did 100 trades, 10, 15, even 20 days out in time, you might have that happen 2 to 3% of the time. Less than 5% is going to be trading right at a particular strike price, unless you really know the stock and you're a really good stock picker. Now the problem. If the stock is above the sold calls, but in the profit range, not yet to a loss, still below the break even, it might be best just to liquidate, to take the profit and move on. You likely wouldn't roll in this position, although you could, but it would consist of liquidating the entire spread you have open and moving out to a new ratio spread at a different strike prices another 10 or 15 days out in time. And if an unexpected event happens and the stock really gaps up, you now have to manage this position. All right. What are some of the ideas of managing a ratio call spread? Now, I want to state again that I only do this in the context of a married put. Owning stock already with a protective put in place, then the ratio spread on top of it is just a bull call debit spread and a covered call. I don't have a naked call because I already own the stock to cover that extra short. Thus, the way I treat the one call in this ratio spread in that structure is just as a covered call. I would take the profit on the debit spread and then roll the call further out in time or up in strike price depending on my goals and requirements. Now, in just the ratio format, as the stock gaps up, goes above your break even, you have to close the naked short legs, the ones that aren't covered by the long call. It may cost you $3 to $4. And remember, the max return you could get was $125. So if that's the max expectation on a 15-day trade, I may need to extend that time frame 3 times, 4 times, maybe out as much as 3 months in order to roll this to a new profitable position. And I don't want to roll it to just a naked call. Perhaps. I personally wouldn't. You could roll the whole ratio spread, but again, what would it look like? Let's say on February 15th, Starbucks is at 71.50. It's 4 points above the 67.5 sold call strikes. I get $1 back on the debit spread, that one contract of 66.50 to 67.50, and I keep the 25-cent net credit, so I have $1.25 in. I have to pay $4 to close the one remaining in-the-money naked short call, so my total loss is $2.75 on the position. Now, to repair this, I'd need a ratio spread with a $2.75 max profit or higher, again, if the stock is trading right at the short strike prices. So let's assume we lose 15 days of time value from today to February 15th, but I could go out to April. Remember, the stock is at 71.50 on or about February expiration. Using theoretical pricing, the April 70 call would be priced around 310, and the 72.50 calls would be around 250. Not a guarantee, but we're using this as an example. So I could maneuver my ratio spread, which took a loss of $2.75, buy to open an April 70 call. I'm fencing in or surrounding the stock price again, so I'm slightly in the money for 310. I'm going to sell two April 72.5 calls at 250, so we'll get $5 in. This gives me a net credit of $1.90. Now, I have a loss of $2.75. Is this really a repair? But remember, if I'm right, and the stock is trading around 72.50 at April expiration, we get $2.50 back from the one contract of the 70 call bought at one of the contracts of the 72.50 sold, the debit spread inside the ratio spread. So the total profit could be $4.40, which might turn the $2.75 loss into a $1.65 gain. Why April? Well, looking at the theoretical prices, the March 70 and 72.50 would not offer a high enough return to counter the $2.75 loss. It would have resulted in a credit of only 10 cents about 45 days out in time, actually about 35 days from February 15th, excuse me. And then you could get the $2.50 back, so you're only at $2.65. Now, that's better than the $2.75 loss, but we're looking to repair to a positive. Earnings should come out after April expiration, sometime around the 25th or 27th, I think earnings are due, but it's definitely something to watch. This is not a structure I'd want to have open through earnings, even if I'm trying to repair it. But at this point, April would be 65 days out in time. Stock would need to be right at 72.50 from our theoretical price trading at 71.50 in 65 days. What are we going to see in 65 days? Lots of time, lots of fluctuation. Other management might need to occur on that position as well. And remember, per Jerry's first comment, if the stock now pulled back from $71.50 and dropped back to $68, $67, you could buy the shorts back cheaply, but the long wouldn't be worth much either. The credit you took in was only $1.90. So you'd need it to still be in that range of $71, $71.50, $72 to pay back the full $2.75. We need 85 cents more on that long haul to profit. All right. So my thoughts on management. Number one, don't, if possible, let the short call become more in the money than the difference in the strike prices. So in our example, we bought a 66.50 and sold two 67.5s. If the stock went up to 68.50, $1 above my 67.5 strike, I'm going to have to manage at that point or look to close out of the spread. Roll out the exposed naked short calls if possible, not the whole spread. So in the first 3 days I entered this position, it moved up. Maybe I just move that one short call up to a higher strike price, like I might with a covered call. But remember, now I still have a naked call at a higher strike price, which might require more margin. That bull call debit spread's doing what I want. I still have a naked call hanging out there. And remember, this is a neutral position. It might not be the best idea to just move the ratio spread at this point to higher strikes or further out on time on a stock that is showing a bullish trend. You don't want a bullish trend. You want a consistent neutral trend so the stock is trading right around those short strike prices in the best case scenario. That's sort of the goals. Now, other management ideas come in at this point in the conversation, and naturally that's what we expect. And they're good comments. So here we are in a ratio spread, sold 67.5 calls, bought half as many 66.5s, and the stock has moved up to $68, $69, maybe $70. Could I convert to a butterfly at this point to help? Well, what would that be? That'd be buying an extra out-of-the-money call. Let's say Starbucks goes to 70. I might buy a 71 if it's available, or 72.50 out-of-the-money call for 40 or 50 cents. What does that do? It cancels the infinite risk if the stock continues to move up. But remember, the price is likely to be higher than that 25-cent net credit we received, which means if the stock pulls back, somehow drops below 66.50 again, I don't have a gain to that side anymore. I've negated that positive net credit if the stock falls. It will cancel the infinite risk, but you're still at a loss at this point. The stock's moving up. You haven't canceled that extra short call, which is hurting the position. Even if the stock pulls back and falls back towards, let's say, the two short strike prices, you may even have a loss there depending on the cost of the outer wing. A good advantage of this also is that it would lower the margin requirement on the position. I don't have the infinite risk anymore. I essentially have a bull call debit spread and a bear call spread to create a butterfly that I legged into. But again, it's going to take away the profit to the downside because your cost is probably going to be higher than the net credit you received. It might even put the peak of the position at a loss depending on how expensive that higher strike call is now that the stock has moved up as well. You will change the dynamic of the position. Well, at this point in the discussion, the other natural comments came in that we'd expect. So then, wouldn't just doing a butterfly or a broken wing butterfly be better at the start and be a more viable trade? Well, it might be better at the start because you don't have infinite risk. I've already said I don't like that. I'd prefer probably to do a butterfly over a straight 2-to-1 ratio call spread. Is it a more viable trade? Well, it depends on what the stock does. Let's take a step back. What is a butterfly? Well, consider our ratio spread, and from the beginning, instead of as a management, add an out-of-the-money call higher than the two sold strikes. It's kind of similar to a condor, but the sold options are at the same strike. In our example, with Starbucks at 67.05, I might use the same legs as the ratio we saw, but buy an extra 68.50 strike call. Same expiration, keeping the same distance between the strike prices. So again, we buy a slightly in the money 66.50 call for $1.25. I sell two 67.5 calls, slightly out of the money, for 75 cents, so I get $1.50 in. Now I buy to open that 68.50 further out of the money call for only 35 cents. Now instead of a credit, I'm in a debit of 10 cents to pay. Plus, this 67.50 to 68.50 spread is a bear call spread. It's part of the wings of the butterfly, but it is a bear call spread, so my broker may require me to put up an extra dollar to cover the margin of that portion of the spread. Now, best case scenario again, stock's right at 67.50 on February 15th. Max profit is 90 cents. Okay? How does that work out? Well, we have a four-legged structure. To start, we get rid of that infinite risk and high margin compared to the ratio spread. Now I do have two ways to lose, simply because it cost me a debit to get into the position. And you look at it and you say, wait a minute here though. The maximum risk, if the stock is way below 66.50 or above 68.50, is only 10 cents. In order to make 90 cents, that's a 1-to-9 risk-reward ratio. How can you possibly miss with this strategy? It is a great risk-reward on paper, but look at it. That 9 times win, 90 cent max profit, occurs if the stock is trading right at 67.50. You get the dollar back from that bull call debit spread. The bear call side expires worthless. We paid a debit of 10 cents, so we have 90 cent profit on a 10 cent maximum risk. How can we possibly go wrong with this win-loss ratio? Well, keep in mind the goals. This structure means the stock cannot move. We want it to be trading right at 67.50 or maybe plus or minus 0.5% from our sold call strike prices. Over the years, this is what I've seen as far as the expectations on butterflies. If I did 100 trades over a 1-year or 2-year period, opening either just call butterflies, iron butterflies, whatever, 2 to 3% of the time, under 5% of the time, am I naturally going to make that maximum return with a stock trading right at a specific strike price. 10 to 15% of the time, I may be 1% above, 1% below, still in a really good profit range of 50, 55 cents or so, half of what the maximum profit expected. 50 to 60% of the time, I'm getting only maybe a 10 or 15 cent profit on the position, 7 to 8 to 10 cent loss on the position, and 15 to 20% of the time, you see the maximum loss above the highest strike call or below the lowest strike bought call. So how can you go wrong with a 9-to-1 risk-reward ratio? Because about 50 to 60% of the time, you're only making 10 to 15 cents or losing 5 to 10 cents. Only 2 to 3% of the time are you making the maximum. Okay? A butterfly requires constant management, moving one short leg, rolling one of the spreads, moving one of the other spreads, other management techniques we talk about in our 8 ways to manage a bull put credit or bear call credit. I would apply that to this. But the stock is not just going to sit there and be stagnant. It's going to fluctuate. And as it fluctuates, I have to adjust one leg or the other, one spread or the other, my bull or bear spread that makes up the combination, to be profitable. Now, if 75% of the time or more, you are able to pick stocks that are going to be trading right at or no more than maybe 0.5% above or below a specific price in a 10, 15, 20-day period, you can be successful with this without management. You also don't need my help or my education to be profitable. Because if you can do that on a consistent basis, I don't think you really need any further education. You should be doing extremely well. I can't do that. I don't do that, which is why butterflies are not part of my personal repertoire. Well, what about a broken wing butterfly? Well, broken wing is a similar concept. But rather than keeping the strike prices even, in our example, it was a 1-point strike difference from the call that we bought, the 2 that we sold, and then the next call that we bought. I'm going to buy that final call that's further out of the money at a much higher strike price to try to keep the net credit on the position. Same structure, buy a 66.50 call for $1.25, sell 2 67.50 calls at 75 cents, $1.50 in, 25-cent credit at this point, and then I buy to open a 70 call, same expiration, for only 15 cents. Now I keep a credit of 10 cents, but again, I actually have to put up the monetary requirement on the bear call side. This is actually $2.50, not $1. But the max profit is now $1.10 because we get the $1 from the bull call debit, we keep the 10-cent net credit, but the return percentage is lowered because we have a monetary requirement of $2.50 between the one sold 67.5 call and the bought 70, essentially a bear call spread. Because of a wider strike difference, the risk is higher. Maximum risk would go up to 140 in this case. But because we keep a credit, there's still only one way to lose, and that's if the stock goes up. Doesn't change the fact that this is still a butterfly. It is still a neutral position. My target would be for the stock to be trading right around 67.50 on or near February expiration, looking for some time decay. If I'm wrong and it falls, still make a 10-cent profit. Because let's pause for a moment and consider this. With just this structure, selling 2 67.50s, buying a 66.5, and buying a 70, just one contract versus 2, for this particular broken wing butterfly, the net credit to the downside, well, the net credit is 10 cents, which is the profit if the stock really collapses. If you just did this 2-to-1 butterfly ratio, broken wing, what are your commissions for a 4-legged entry? that's probably going to wipe out that 10-cent net credit, isn't it? And it's always something to consider with these strategies as well. Okay, so while we're on ratios and butterflies, another comment came in about, what about a 1 to 3 to 2 unbalanced butterfly? And now we're going further down the rabbit hole of all these different combinations, butterflies, ratios, 5 to 3s, 3 to 4s, and so forth. Okay, but we want to address the question, what about a 1, 3 to 2? It's still a butterfly. It's called unbalanced because you have more contracts on one side versus the other. We could still look at this as a 1-to-1 bull call debit spread and then a 2-to-2 contract size bear call credit spread. The structure again, buy to open 166.5 at 125. I now sell 3 February 67.5 calls at 75 cents. So we get 225 in. Now I buy 2 February 68.50 calls at 35 cents to pay 70. So the total coming out is a net credit of 30 cents. Higher than the 25 cents or so we got on the initial ratio spread. Higher than the 10 cents from the broken wing butterfly. Maximum risk is still 70 cents, and my max profit is $1.30, because I could still get that extra dollar from the bull call debit spread. Here's our profit and loss chart. What's the payoff of this ratio, a 1 to 3 to 2, butterfly, not broken wing? Well, we get a slightly higher return over the ratio, and more than the maximum profit of 90 cents on the butterfly we showed. Straightforward, looking to make maximum profit of $1.30 for risking 70, we're at about a 2-to-1 risk-reward ratio. I'm sorry, a 1 to 2 risk-reward ratio. But remember, I've got a bear call spread on this side times 2 contracts. So that's my margin. I've got to put up the $2 to cover the bear call side. So the max risk, or the total requirement, is $1.70 in this case. Now the higher net credit does mean better profit to the downside. If Starbucks again falls below our 66.50 strike, all calls expire worthless. We make 30 cents here instead of the 20 cents or the 10 cents that we saw on the butterfly. That's the payoff. But there's a high risk to the upside because of the margin requirement of the bear call of doing twice as many contracts. So let's review. Are they viable? Well, the call ratio is spread common, buy 1 lower, sell 2 higher, get a credit, takes on infinite risk to the upside. The call back spread gives you a profit to the downside if structured correctly. Max loss only occurs if the stock is trading right at the 2 higher bought calls, and if the stock really takes off, you have infinite upside. Good strategy to use the back spread if you're bullish on the market, bullish on stocks. Because you might take a loss in the middle, but if it goes one direction, you still profit. If it goes the other direction, you could really profit. Butterfly. Great risk-reward ratio on paper, but remember, you're not going to make the maximum profit on your butterfly 50, 60, 70% of the time. Without management, you might only see it 2 to 3% of the time. The bulk of the time, you're just going to see a little profit or little loss. And this assumes without management. And then, of course, on the right-hand corner here now, we have the structure that Mark brought to us of the 1 to 3 to 2 spread, which gives you a little bit more profit if the stock falls to the downside because the higher net credit does take a higher risk to the upside. The goal, again, just like the standard ratio spread, is to have the stock trading right at the short strike prices, same as with the butterfly as well. So are they viable? Well, ask yourself, are you constantly picking stocks that match the structure of the trade? Going on to Jerry's question review, management to the upside with ratio spreads. It's important to close or control the issue that is causing the loss, those extra naked calls. Buying a higher call once it starts to move against you will stop the infinite loss, but it's going to change the dynamic of the spread, and if it keeps going up, you've just locked yourself into a loss. You didn't close or control what is hurting the position at this point. If the trend is going against you, and Your stock that you thought was neutral now appears to be bullish. Why would you continue a neutral position by simply moving the spread up to higher strikes and further out in time? You're likely just going to have to manage that at another point. Okay? At this point, you might just want to close the spread, find a different stock or a different strategy. Think of your trades over the last 6 months, 8 months, maybe even the last year. Think of your stock selections for strategies that you were using. Based on the average movement of the stocks that you picked, would any of these 4 strategies have been successful with no management? That's a base point. Then you can delve into the management later on. But do you consistently pick stocks that trade plus or minus 1% of a certain strike price over a 10, 15, maybe even 20-day period? If not, you're going to have to find a new stock selection process to make these strategies viable in your account. Okay? And consider that the ratio spreads that we originally discussed, the butterflies we're looking at here, even that ratio butterfly that Mark brought us, is going to require management to stay in the profit zone as the stocks fluctuate. Regarding the butterflies again, whether you do all call butterflies, all put butterflies, or if you do iron butterflies, combination of a bear call credit with a bull put credit spread to create a similar profit and loss chart. My experience over time has been 2 to 3% of the time, with no management again, you might expect the stock to be at the peak. 10 to 15% of the time, you're at about a 50% of your expected return. 50 to 60% of the time, you're maybe making 5% or 10% of what you expected, or losing 5% or 10%. And then maybe 15 to 20% of the time, you're hitting the maximum loss. This doesn't mean that butterflies are not viable or profitable, but is part of your trading plan consistent management on the spreads that you open, because that's what is required to profit long term on butterfly positions. Or are you good enough where you can pick stocks that will trade at an exact price 10, 15, 5 days out in time, maybe 20 days out in time, or maybe just plus or minus 0.5% of that strike or that particular price 75% of the time or more? If that's the case, you could probably be successful with butterflies without management. But again, 75% of the time or more, picking an exact price or no more than 0.5% above or below that 75% of the time. Very difficult. And of course, this leads to the other conversations. Going down further into the rabbit hole, there are an infinite number of variations with the ratios. 3 to 2s, 5 to 4s, 5 to 3s, 7 to 4s, 7 to 5s, and so forth. Even with butterflies. I like Mark's structure. It does have some benefits, but with good benefits also becomes some non-benefits to the strategy. But it looks pretty good. It's still a neutral position, but it does look pretty good. But again, a butterfly could be done as a 1-2-1, a 1-3-2, maybe even a 3-5-2. There's various combinations. Look at the chart. Does the structure of the trade meet your goals? Does the structure of the profitability range of these strategies meet your stock selection? The movement of the stocks that you select, whether you think you're bullish or bearish, how do those stocks move, and would these structures profit long term? Does it also match your risk tolerance? Well, on paper, again, everyone can say the butterfly spread absolutely matches their risk tolerance. I'd love to have a 1-to-9 risk-reward ratio. But remember that 9 times reward will only happen 2 to 3% of the time without time allocated for consistent management on the positions. Do you want to spend your time managing the butterfly spreads or the ratio spreads on a consistent basis with the stock fluctuations? Also consider the cost of management. I enter a spread, let's say Mark's position here in the lower right-hand corner, the 1-3-2, that gives me a 30-cent net credit. But I only did a 1-3-2. I had to open 4 options to do this. So that 30-cent net credit might only become 15 cents maybe less. But I know I'm going to have to manage it consistently to remain profit. And every time I manage a position, I'm likely lowering the maximum return, increasing the risk in one direction, and paying additional commission fees that are cutting down that 30-cent net credit I originally received. It was probably already cut down to 15 cents when I opened the position. So that's something you want to keep in mind with these strategies as well. And then if you say, oh, well, it's simple, we just multiply everything and do more contracts. Now, is the risk tolerance still there? Have you increased the risk too much to try to force this strategy to be profitable by trading more contracts? Does it still match your trading plan? Well, thank you for watching me on my discussion on ratio spreads that led to the discussion of butterflies as a management, and more. These are just my thoughts on the structure, the expectations and outcomes of ratio spreads, different types of ratio spreads, butterfly positions. You can check out our other videos on other strategies, other approaches to different strategies as well on the Power Options Archive webinar page, powerop.com/webinars.asp. You can always check us out on YouTube, youtube.com/poweroptions. I'll see you next time for our next strategy discussion.